the way we're allowed to let you participate by phone is to have a quorum present vote to allow you to participate by phone, and we don't have a quorum yet because, of course, our one member, Mark Dighton, is no longer an elected official, so he's not here, and Dave Eggers has said he's coming, but he will be about a half hour late, is what we heard last night. So in about a half hour, when Commissioner Eggers gets here, we'll vote to officially acknowledge your presence by phone. But in the meantime, hopefully your Granicus is working, and we'll go ahead and start the presentation with the auditor, and then hopefully by the end of that, Commissioner Eggers will be here. So
okay, sounds good.
That's the game plan.
All right, thanks.
Okay.
Okay.
So we'll skip over the.
First couple of items.
We'll go right into the audit.
Okay.
Well, good morning.
Good morning.
Today,
You probably need to speak up a little bit, Debbie, so Brian can hear you on the speaker.
okay. Let me know, Brian, if you can't hear me.
Okay, thanks, Debbie.
Sure. Today I'll be introducing Andrew Laughlin, the principal at Clifton Larson Allen. And we are concluding with the audit today for 2016. Very happy to say there were no material weaknesses, no internal control deficiencies, and it's gone very well. He's been quite a help, the whole team has, with coming up with some best practices for us. And I'm going to be introducing Andrew, and we also have Sue Pagan here. If you can come forward and give your presentation. And Andrew is going to be explaining our FRS challenge this year. If you recall, last year we had a challenge with FRS getting the data to us in a timely manner. This year it came a bit more timely, but not without some consternation over assumptions used. So with that, I'll turn it over to you, Andrew.
Thank you. Seems like we have a challenge now every year, so we'll see what fun next year brings with the year number 3 of our FRS GASB 68 implementation. So let's just run through the slides real quick. Just going to give you a quick overview of the engagement team.
Hey, Brian, it's Bill Johnson. There's some background noise on your phone. Could you mute unless you want to speak?
Yeah, I sure can. I'll do that right now.
I assume that's on your phone, the background noise.
Well, we'll find out here very shortly, so.
Oh, that worked, so. Well.
Is it on my phone call?
Is there anybody else on the phone call besides Brian? Don't hear anybody. The background noise seemed to go away.
Okay,
Well,
let's start over.
all right, so who am I? Why am I here? I'll project loudly so to make sure everybody can hear me, especially you, Brian, on the phone. If you have trouble hearing me, Brian, feel free to unmute and say, I can't hear you, please speak up, and I'll do my best to project even more. Just going through the engagement team, Brian, I know you don't have the luxury of seeing what's here on the slides, but I'll just kind of walk through each slide.
It's on Granicus.
Oh, he does have the Granicus.
And actually, I'm watching this live streaming, so I can see it pretty well.
Oh, boy. I'm on TV. Pressure is on. Here we go. Don't screw up. Don't screw up. All right. Overall, the CLA engagement team, the great thing here is we have the recurring team from last year, so there wasn't significant turnover within our team where we had to bring new people in and try to relearn the inner workings of PSTA. So we had largely the same players. Me, as I was the overall engagement principal, had overall responsibility for the audit of fiscal year 2016. Sue Pagan, she's an engagement director. She's had overall manager type roles and responsibilities within this audit. So Sue is my right hand. Cam also did a lot of the dirty work. She was the senior that was really the one on site most of the time, working through the testing. And she had some staff associate assistants along the way. Our IT audit team, I've got a slide in here to kind of talk about some of the IT procedures that we have done and will be doing. But the audit assistance that the IT team provided in evaluating the general computer controls, application controls within PSTA, that was largely handled by Jim Barton. He's a manager. And then we also issue a separate report. It's our agreed upon procedures report on the NTD submission, the National Transit Database submission of information that the authority and all other transit agencies are supposed to provide NTD. We do some agreed upon procedures on certain steps that are outlined by NTD, what we have to do. So I'm leading that along with Monica Sanchez is doing the detail level work on that. And that's currently getting in process as we speak. Next slide, just the type of audit that we do. We do both a financial statement audit and a compliance audit. Financial statement audit basically opines on the actual numbers, financial information contained within the authority's CAFR. On the compliance side, we've got a federal and state compliance. That's the single audit that we do, where we select major federal programs and major state projects and do what's called a single audit on those, both at the state level and the federal level and the state level, each of which has their own requirements on how we conduct that type of compliance audit. Next slide, just the reports that we deliver. We've got our independent auditors report. We have an internal control report. Like Debbie said, if we have any material weaknesses or significant deficiencies, if we did, we would report on that in that report. The report on compliance over major federal program, state project. The little thing that's new there is that's in accordance with the uniform guidance. It used to be in accordance with the OMB Circular A133. That federal guidance has now changed. That was implemented on some part F of the uniform guidance requirements. That's implemented now this year. A few changes that we had mainly was our single audit threshold raised from 500,000 to 750,000. Our Type A programs versus Type B, our selection criteria there, those monetary numbers changed just a little bit from prior year upon implementing the requirements in subpart F in the uniform guidance. We have a management letter. We always issue that every year. That's required by the state. We do provide a governance communication. I'll go through some of the highlights on a later slide on what that letter will contain. And then our examination report, that's on your compliance with your investment policy in accordance with Section 218.415 Florida statutes. Next slide, just the results of the procedures. We have an unmodified opinion. I did put in parentheses that was tentative. That didn't go without drama, as Debbie was alluding to earlier. Basically, there was an issue with the actuarial valuation that was performed by the actuary Milliman of FRS, that there's a prescribed discount rate and long-term investment rate of return that was used in the valuation, but that wasn't the rate selected by the actuary. That's the rate selected by the plan itself at a conference. I forget what the conference is called, but they're the ones that tell the actuary, here's the long-term investment rate of return we want you to use. Let's use 7.60%. So that's what Milliman used in its valuation, but they took exception to that. They felt that that rate should have been lower, more like 6.6%, or maybe it was 6.3%. And so that caused a lot of controversy. So the question was, well, can we rely on this valuation and the resulting net pension liability that we're supposed to report on our books if the discount rate is too high? Eventually, that all got resolved as of yesterday, so this is kind of hot off the press that issue did get resolved because Milliman did provide a subsequent letter kind of explaining their position, offering some more latitude, because it all is an estimate, it's an assumption. And then we also did some audit procedures on our own where we hired or engaged our own consulting actuary to look at the discount rate that was used in the valuation of the FRS plan, and that consulting actuary felt that the 7.60% was within reasonable limits. So we got through that, so we're now able to issue an unmodified opinion after clearing that hurdle. We have an internal control report.
Are you going to be coming back to that again, or is that all you're going to say about it? Because I wanted to ask a little
about that particular issue. Yes, I do have some slides on just the net pension liability of the authority and changes therein and what caused the changes, but specific to that issue, I think that's all due to address it. So yeah, please ask away.
The question I had, the 7.6%, that was their auditor or their actuary, who said 6.3%?
So the actuary was Milliman. Milliman was the one that said, we feel 7.6% is too high, and so they had this disclosure in their actuary evaluation to express their concern that it is perhaps beyond reasonable limits. The auditor is the Florida Auditor General of the Florida Retirement System. They had what's called an emphasis of a matter paragraph in their opinion to basically highlight that fact, that there was a disagreement out there. But the Auditor General did not modify their opinion, or excuse me, did not qualify their opinion. They issued an unmodified opinion, so there was no qualification, but they did have that emphasis of matter. And so then the various auditing firms around Florida, ours included, evaluated that further and said, well, if the discount rate is unreasonably high, that could have a material impact on the net pension liability we're reporting for our respective entity that we're auditing. Do we have enough information here to issue an unmodified opinion? So that's where all the craziness ensued in trying to evaluate next steps. And so there was multiple, there was a laundry list of things that happened, but mainly it was some firms, including ours, engaging our own actuary to make their assessment so we can get sufficient audit evidence. The Florida Auditor General did the same thing. They engaged Gabriel Lawyer Smith, but then they sent out a release to say, Gabriel Lawyer Smith said this is reasonable, but we're not going to release that information. That's our own private information, our own work papers, so it's not going to be available for public consumption. So then that was difficult to rely on that if we couldn't get the documentation. And then it was whether or not we could get something else from Milliman to maybe provide some more support for their position, or maybe get Milliman to say, well, there is some latitude here. This is our judgment based on XYZ reason, but perhaps within the actuarial professional standards, the 7.6 that was used is still okay. And so Milliman did issue that. I saw that come out just yesterday, and then our firm met internally, and that's how we got to the conclusion that we could rely on this. And I think that's where most firms are coming out, but I can't obviously speak to other firms.
So Milliman kind of retracted or modified their original?
I wouldn't call it a retraction, and I'd be happy to send you what the letter that Milliman did issue, but it gave some more latitude, like I said, more latitude in terms of what is considered within reasonable limits.
So, okay.
Yeah, thank you.
I have really two things on that. First of all, we're investing primarily in cash equivalents, so even 6.3 seems kind of high, but...
well, if I could stop you there real quick.
Yeah.
That is PSTA's investments.
Right.
We're talking about investments.
Assumptions.
We're talking about investments in the Florida retirement system,
Yeah.
which is,
Okay.
a very large,
Yeah.
multi-billion-dollar portfolio.
The second question is, isn't there some kind of decision tree guideline for this kind of thing? I'm sure it comes up periodically. That there's somebody who supersedes the other people who are making requirements or suggestions.
Well, that was, I think essentially what happened is when Milliman put out their disclosure in their report, it's what raised a lot of questions. So I almost wish Milliman issued their letter sooner than they did, because all what happened is more questions were asked without answers timely given about, okay, is this unreasonable that it's not in accordance with generally accepted actuarial professional standards? And so that was the crux of the matter, and that's kind of the clarification that Milliman later reissued in their letter that just came out recently. So I think at the end of the day, if we had gotten some kind of response from Milliman earlier, then this wouldn't have festered like it did. But hey, at the end of the day, we're in a good place, and that's that's what's important, that we
Right,
can move
so
on
that-
from this issue.
That tentative parentheses
That can get-
will eventually be removed?
Now we'll get removed,
Okay,
yes.
thank you.
Yeah.
Hi, Mr. Chairman, I have a quick question.
Yes, sir, go ahead.
So are we pretty much in line with other public agencies, or are we an outlier in this?
Well, you're in line with other public agencies. Basically, what FRS tells you, here's the net pension liability of the entire plan, and now we have to now divide it amongst all of our participating entities. So that is what it is. There, potential outliers when this issue was came to light was the different auditing firms of the different agencies maybe coming to different conclusions. One on saying we have to qualify our opinion because we don't have enough information to support this discount rate assumption, given the concerns that Milliman raised. Others saying the Florida Auditor General said it was okay, so we're saying it's okay. Others saying, well, we should have an emphasis of a matter paragraph in our opinion. So the divergence of opinion came really within the auditing firms auditing these other public agencies. I think now that this Milliman letter came out just recently, you're going to see more audit firms coming to the same conclusion. But again, I can't speak for other audit firms. I just know we've come to that final determination that we can issue an unmodified opinion given all the evidence that we've accumulated.
Okay, thank you, appreciate that.
Is that it, Brian?
Yes, thank
Okay,
you.
sure. Okay, sir, thank you, proceed.
Great, let's go to the next slide. So, on this slide, let me pull up the... So here, just kind of talking about some of the procedures that we performed. As you know, we do a very in-depth analysis of the internal controls of the authority. We look over everything. So any significant process, significant account balance, we evaluate not just to test the actual number at the end of the year, but also what are the underlying processes and related internal controls that drive those transactions that make up that ending number at the end of the year. And so we look at internal controls over cash, investments, inventory, revenues, receipts, payroll, AP disbursements, capital assets, self-insured claims in the self-insured program for risk management, and workers' compensation, and then their overall financial closing process. How do they close the books? How do they make sure that accruals are booked in the right period? How do they prepare the information to present the CAFR? We look at all those controls as part of our audit procedures. We also, each year we try to do maybe something different. So you can say, well, last year was our first year of audit, so that's relatively new. And then this year we looked at some of the audit procedures we did we looked at our procedures across the board we did last year. We said, all right, what are maybe some different unique things that we can do, incorporate this year into the audit? And so one thing that we focused on was our testing of purchasing card testing, or P-card testing. And so we made a selection of P-card transactions and looked at cardholders and their limits and did some test work around that, making sure the proper controls were in place. We found those controls to be properly designed and implemented, so we did not see any unauthorized purchases, which is great. We feel it's operating well. We did have some best practice recommendations that we did provide to management that they can implement going forward. A lot of that surrounded around making sure we have supporting documentation for any changes in the credit limits, not only if they go up, but also if they go down, so we have a proper audit trail. So if we come audit this stuff next year and there's a credit limit change, there's supporting documentation behind it that we can view for audit purposes. So just some little tidy up things here and there on that, but overall we found the P-card process to be working well. Well, also we did our IT security services. So I mentioned Jim Barton comes in and provides us with assistance in our audit, looking at the IT environment and looking at the controls around information technology to help us in our assessment of risks to the entity. And we also do some special procedures as well, some security-focused procedures. So Last year, we had our what we called our pen test or external penetration testing that we did. This year, our focus is going to be on an IVA or internal vulnerability assessment. So really the difference there is that an IVA really is where we want to identify and quantify security vulnerabilities in a particular environment. So we're kind of asking the question, hey, what are these weaknesses and how do we fix them? Whereas an external penetration test is what we did last year, and that's more emulating a cyber attacker to come in and not really knowing what the IT infrastructure is, the security infrastructure in place, but we're going to be coming in from the outside and trying to penetrate and hack and see what information that we can obtain, what sensitive data we can gain access to in a fraudulent nature. And so we played that ethical hacker last year, trying to penetrate the system, see what we could get into, and then whatever we could, we learned from that and made those necessary fixes. This one is more saying, all right, now we know the environment, we've made inventory of our IT security, assets, infrastructure in place. Let's look at those more closely, evaluate if there's any vulnerabilities, and make the necessary fixes. So it's a good two-pronged approach, one on the external penetration, that's kind of the outside looking in, the internal vulnerability assessment. We're in the inside, we're taking inventory of everything, and let's test all the specific infrastructure that we have and see if there's vulnerabilities and make those fixes. So it's a good 1-2 punch to make sure that the environment that you have here is as secure as possible. Questions on that?
Yes, go ahead, please.
The internal vulnerability assessment, is that where somebody here would click on a link that would open up potential
Virus.
software? Or is that what that internal vulnerability is?
That's more social engineering, and that's what we did with our external penetration test. So that's where we sent an email pretending we were the Microsoft support team.
Right.
We sent an email, so I'm not sure exactly how many employees, and we just took note who clicked that link, and then to the extent that people did click the link, and then we were able to access workstations and gain further access to sensitive material. We took note of that. And then, suggested for those that did that, have employee-wide training to make sure that, you understand your responsibility as a user with access to the network, what you should and should not be clicking. So that was part of the pen test that we did.
Is that process and reinforcing that caution continuing, or was that just last year and now we're not paying attention to that?
Well, and I'll let management speak to that further. That's the implementation piece that I would say is ongoing, if you all wanted to speak further.
Yeah, I think that's something that's ongoing, and I think Deborah will want to say something, and I did internal controls training for everyone this year as well. And that's one of the things we touch on are the IT controls.
Yeah, just to add to that, Bill, to your question, yes, we actually relook at our process continually to make sure that we're meeting the guidelines of what Andrew and his staff has set up. To expand on what Andrew said, we only had very minimal amount of impact as far as intrusion into the network itself, because we already had a lot of those security processes already in place, and we already had security software in place to address some of those issues. So overall, we did very well when it came through the external penetration vulnerability test. We'll see with the internal vulnerability test what comes up.
Thank you.
Thanks. Brian, do you have anything on that?
Silence means he's good. We'll move on. So here's the governance communication. So we issue a letter each year. That's our required communication, a governance letter, and it goes over, covers various things, what is significant estimates, disclosures we had in the CAFR. Were there any difficulties that we had with management, any disagreements? I'm happy to state that we did have no disagreements with management. We have a great working relationship. We appreciate all their assistance throughout the audit. And I know they did have, turnover, key personnel with Marnie Maxwell leaving and kind of leaving a bit of a void in some areas where she was the process owner. So they've worked diligently to pick up those pieces and get us what we need to support our audit opinion. So we appreciate all their efforts throughout the process. A couple things we had, just uncorrected misstatements. So we did identify misstatements but they remained uncorrected because they're not considered material. So if they're not immaterial, management concludes on that, we concur, and we move on. We're just required by our professional standards to include those in what's known as the management representation letter that management signs, and this governance communication letter that's basically for your edification. The two uncorrected misstatements you see here relate to AR and revenue for about $215,000. That relates to grant reimbursements. So we submit our reimbursements to the federal or state grantor agency. There were reimbursement submissions subsequent to 2016. They were in 2017 in various grant draws, and we noticed that there was some underlying expenses from vendor invoices or payroll-related stuff that did relate to 2006 to FY16. Those were not considered material to the financial statement, so we were able to pass on that proposed adjustment. But that's the amount, $215,000. We've worked with management since then on devising a kind of a standard process on how to tackle that. Debbie can speak to it further, but it's basically identifying, okay, here's a threshold. Anything over this threshold, let's evaluate. If it's under it, it's completely immaterial. Wouldn't even amount to showing up on this governance letter. So we have a standard practice going forward on how to address those items that we submit for reimbursement subsequent to year end, but maybe related to the prior year where we know we're going to get revenue from that. And so that's how we're going to handle that going forward. Another one, this is just a reclassification issue from a depreciable asset or non-depreciable to a depreciable asset. Didn't happen timely, but it has no impact really on the statements other than a presentation issue within capital assets from one line onto the next. We just want to make sure it gets done so that we can start depreciating that asset over time. And so that's been fixed going forward, and that reclassification past adjustment remains for 2016. A couple other just informal recommendations we had to management. So when we evaluate capital asset additions and look at assets as part of our single audit procedures, we noticed there was a bit of inconsistency, lack of consistency on placing asset tags that have all the relevant identifying information on the assets. We've noticed for many of them, but some were missing. We also want to make sure that the funding source is clearly identified in their capital asset module, so they have all the right information in that module to know what's grant funded and what's not, because they need to track that appropriately. So just some consistency of practice there was our verbal recommendation to management. Then also we have the reconciliation of the Cigna impressed account. So I'm not sure if you're aware, but the authority modified its health plan a bit. They stay with the same provider as Cigna, but Cigna has this solution called the Cigna Shared Returns Minimum Premium Program. And so that program is essentially you can get your premiums lower. So there's basically paying largely just an administrative fee and then some premium for some excess insurance that they're getting covered for. But on the flip side, the authority is responsible for paying its own claims, but it's only going to pay claims up to a certain threshold, and then after that, the processor, Cigna, as the insured party, comes in and covers the anything that's over the excess. PSTA did hit its excess during fiscal year 2016, but what happens as a result of this new program, which is kind of a semi-self-insured program, they're required to maintain an impressed account that basically they remit money to this account. It's still a deposit. It's an asset on PSTA's books, but it is supposed to be continually replenished and funded up to a certain amount, and that account's going to be used to pay claims. We want to make sure that account, it's new this year, it gets reconciled regularly, and then it's replenished to its required amounts according to the agreement they have with Cigna. And that's the resulting, that asset has also created a restricted net position because the monies in those accounts are restricted only to pay claims. So that's a bit of a presentation difference from last year to this year because they now have this account. Next slide, just some upcoming accounting standards. So we last year had to implement GASB 68 and pensions. That's a new pension standard. We're going to be implementing GASB 75. It's actually not effective for our fiscal year until our fiscal year ending 2018, so we've got a little bit of time on this. But it was curious to me is, okay, what is the impact of this going to be? And I we really won't know until we implement 75, but I'll tell you, Hillsborough Transit Authority did implement early GASB 75, so I kind of looked at their valuation, and I looked at PSTA's valuation under the old standard, which is GASB 45, just to see if one OPEB liability is much higher than the other, and I really didn't see that. Just to give you some of the numbers, Hart's OPEB liability at the end of the year under GASB 75 was a little over $1 million. They had only 6 retirees participating in the plan, so it's real low participation rates amongst the retiree population. A lot of that has to do with your employee demographics. Generally, they're working until at or near age 65, and then once they hit 65, they go on Medicare, and they don't stay in your plan, because the requirement is that if you stay in the authority's plan upon retirement, you have to pay your own premiums. So Hart's OPEB.
I'll stop you 1 second.
Sure.
Brian, just so you know, Madam Chair just entered the room, so be on your best behavior.
Okay, will do. Thank you.
Yeah, okay, good to see you. Okay, could you give us a 2-second blurb on GASB 75 on what we, as lay people need to.
Sure. GASB 75 largely is meant to mirror what happened in GASB 68. So GASB 68 said, let's evaluate.
Oh, okay.
That cleared it up a lot.
I'm sorry. But GASB 68 is the one on pension. So that's what all this FRS dilemma we went through, that's a little more complicated because that's a multi-employer plan. PSTA has its own OPEB plan, and it's not really one that it's fund, it's pay-as-you-go, meaning whenever they have to pay retiree claim payments, they're just making the payments, because the retirees pay their own premiums under this plan. So there's what's called the implicit rate. Basically, if the retiree would try to go out on their own and pay for their own plan, given their age, they'd be paying higher than what they can pay in the premiums under the PSTA's health plan. So there is a break that they're getting because they're now mixed in with this younger population and employees, and so that creates an implicit rate subsidy, it's called, and so there's a liability associated with that while they're an active employee. Basically, the real question is, all right, so when we implement GASB 75, are we going to see like this skyrocketing net OPEB liability upon implementation? And I don't seem to think so, based on me comparing it to Hillsborough Transit Authority down the street, who did early implement 75. Your net OPEB obligation at the end of the year was about $2 million. You only had 11 retirees participating in the plan. HART had 6, so you had a little more retiree participation, but HART has 807 active employees. PSTA only has 564. So I think the demographics are a bit comparable there, yet your net OPEB obligation was double HART's, and they implement 75 and you're still on 45. So I don't necessarily envision, and I'm not the actuary, so I'm not the expert that can speak on it as well as they could, but I don't envision your net OPEB liability when you do implement 75 going up dramatically.
Thank you.
The other standard here is GASB number 72, that's fair value measurements and application. That was big for a lot of local governments implementing that because their investment portfolio, they now had to make a lot of new fair value disclosures that are required under the statement, but this did not have an impact on PSTA because you have about 42 million in what we call in practical terms investments, but what they really are is they're money market accounts and certificates of deposit with Bank United. And so for practical purposes, yes, they're investments, but for financial reporting purposes, those are actually considered deposits because they're valued at amortized cost, and that's how we're reporting them. And since they're not valued at fair value, GASB 72 disclosures do not apply. So that was one that we kind of sidestepped because our investment portfolio doesn't contain any investments held at fair value. Last thing I'll just go through is just a couple financial statements.
Mr. Chairman,
Oh, sorry.
So if we were investing in assets that that have a, let's see, because we are investing in basically cash, we record any appreciation as it occurs, rather than if we were investing in, let's say, land that had an appreciated value that was not reflected in our books. Is that what we're talking about here?
Well, a couple points you raised there. So if you invest in land and that land is used for operational purposes, you buy land for the purpose of building a shelter on it and used for transit purposes, that's used in operations that wouldn't be measured at fair value. If you purchased a parcel of land with the intent to later sell it at a profit, then you'd have to record that land at its fair value. So that's based on appraised value. In terms of investments, your money market accounts and CDs, if you had, let's say, investing in government agency securities or corporate bonds, those, the amount you purchase that at later on in the fiscal year, as interest rates change, supply and demand changes, you have fair value changes throughout the year. At year end, you'd have to true up whatever that purchase cost was to whatever the fair value is and make that change there.
All right, thank you, Mr. Chairman.
But that never changed. You would always report those at fair value under GASB 72. The difference is now you have all these new disclosure requirements about how you measured it at fair value, what's this hierarchy leveling that you have to do. I won't bore you with the details, but it's a lot of additional disclosures. We just didn't have to do it because we're only invested in deposits. Real quick on just, I like to give you all just a kind of multi-year depiction of the balance sheet and income statement of the authority, see if there's anything that now happened in 2016 that really might jump out at you when looking at the CAFR compared to previous years. Really the only thing here that I see, capital assets really went down from last year. We had only additions of 2.5 million. Last year we had 15 million of additions. Last year the authority purchased 21 hybrid buses, and that was about $700,000 a bus. This year we had no bus purchases. That 2.5 million is really buildings and improvements, some structures, but obviously a lot lower. Our capital assets net went down, but that's because of depreciation. So depreciation outpaced what we incurred in additions. Next slide. Just on the liability side, again, a lot of consistency here across the board on our liabilities. You can see other post-employment benefits that does keep creeping up from year to year. We talked about that previously. Then you got the net pension liability that went up from 17 million to now 26 million. So that is quite a jump. I can give you some insight that if you like.
Those numbers, I mean, from 2013 to 2016, I take it in 2013 to 2014 there were changes in reporting?
Right.
Okay.
So in 2015 is when the authority implemented what's GASB 68, that's the new accounting and financial reporting for pensions. They implemented that retroactively because the authority presents comparative financial statements, and we had sufficient information to be able to identify the liability in both 14 and 15. We don't have enough information for 13, so that's why that's 0.
Could you go back one slide?
Sure.
Yeah, Mr. Chairman, I have a question when you have a minute, please.
Okay, is it on this slide, Brian?
On the slide, I think it was the last slide, not the liabilities, but the assets.
All right, go ahead. Yeah, I just asked to go back because I had a question also. Go ahead with your question.
Okay, thank you. And this may be more of a question for staff and perhaps maybe a subject matter for a future finance committee meeting, but I noticed in the parts and supplies for buses, since 2013, there's been about a 60% jump in that category, and a big jump from 2015 to 2016. And with $1.6 million on hand, that works out to a little over $8,000 per bus for a 200 bus fleet, which is about double what we typically see in the private sector. And I'd just like to dive a little deeper into that at some point in the future, and find out if that's necessary, appropriate, and sort of why we've seen such a big jump in that category.
Okay. Yeah, go ahead.
Piggybacking off of Brian's question, would that increase reflect our decision to invest in Henry Lukasik's maintenance program, where we decided to put more effort into fixing buses to stretch out their life?
That's what I think, but Henry would know better.
Yes? Okay,
Okay.
the answer is yes.
All right. Does that answer your question, Brian? You want to, you have a backup question or follow-up question?
Well, I think it's probably not really a question for the auditor so much, but that stood out to me, and I think maybe for a future finance committee meeting,
Okay.
I'd like to get a little deeper into that, because
Okay.
Yeah. We can.
inventory can be a big drag, and I just want to make sure we're not overdoing it there.
Okay, good. All right, that's a good question. All right. My question has to do with the fact that 2013 and 2015, we have similar size additions to capital assets, and in 14 and 16, very small additions. Does that have to do with our purchasing time frame, or what's costing that fairly wide disparity on an every other year basis?
If you want to
It's
address.
a purchase of buses,
Uh-huh.
so.
All right, but we buy buses every year. It's just
Well-
when we actually show them on the books.
When they actually are received in, like we had a delay in the decision of the type
Okay.
of bus last year.
Uh-huh.
So the bus order that we put in for 16 wasn't actually received until this year, fiscal
Okay.
17.
All right. Okay,
So
thank you.
timing, yep.
Okay.
So, if I don't bore you too much, I'm happy to kind of explain why the authority's net pension liability went up, almost 10 million, because that is quite a bit. There's two components of your net pension liability. There's the FRS plan, which is your standard traditional pension plan, and there's the health insurance subsidy, if you remember from our discussions on this last year. So consider them two separate plans, two separate components to the NPL or net pension liability that we've got to factor in as to why did this balance increase. I can tell you the health insurance subsidy, which is largely unfunded, kind of pay-as-you-go, that's been relatively consistent from last year to this year. On a total basis, we were looking at 10.2 billion with a B from the beginning of the year compared to 11.6 billion at the end of the year. So not a whole lot of change from one year to the next in the HIS plan. This is
Sorry, HIS.
health insurance subsidy.
Okay,
Yep.
all right.
So that's where FRS members receive $5 up to $150 a month for depending on how many years of service that you have, and it's just a cash subsidy that's intended to help defray your health-related costs. So the big jump here then was the FRS pension plan. So that went from 12.9 billion last at 9/30/15, or I should say, excuse me, 6/30/15, because this plan is measured as of the state's, the FRS's fiscal year end, which is June 30, not September 30, from 12.9 billion at 6/30/15 to 25.2 billion at 6/30/16. So you can see that the FRS plan, the traditional FRS plan, is where this huge jump occurred. And it occurred for a couple reasons, mainly due to, you're going to have your interest, what's called the interest on the TPL. That's the interest on the total pension liability. You've got this big total pension liability amount, and then based on what the discount rate is, there's an interest that's associated with that. And that increases the liability, but then generally that's offset by the interest or earnings you have on the underlying investments in the plan. Well, your interest on the total pension liability was 12.1 billion, but your actual net investment gain was only 820 million with an M, not a B. So you can see that was a lot of the disparity from what plan investments earned compared to what the actuary calculates as the interest on that TPL. So we also had a discount rate change. It went from 7.6% last year.
Wait a minute.
Excuse me.
How much? It went from 776%?
The discount rate went from 7.65% last year to now 7.6% this year. So only, 0.05% change. But to put that in perspective, if the discount rate changed a full percentage point, meaning if it was 6.6% instead of 7.6%, and this is where a lot of that contention got in, like, what is the true reasonable long-term rate of return assumption? Should it be 6 point something percent instead of 7 point something percent? It's material, because if the discount rate was 6.6%, that net pension liability would have been $46.5 billion instead of $25 billion. So almost $20 billion more just by changing the long-term investment rate of return assumption by 1 percentage point. And so for PSTA, that would have been $29.5 million instead of $16 million for the FRS plan. So quite a big disparity if you change the discount rate much at all. So that's really what that drove.
So what I hear you saying is that FRS changed their discount rate assumption during the year, which created the $10 million net increase in pension liability.
That was one contributing factor, but not much of one, because that rate only changed from 7.65% to 7.6%.
Right.
Which isn't much.
Right.
But if that thing dropped from 7.65% to 6.6%, it would have been probably another $20 billion.
Okay.
So a lot of it was the interest on that TPL outpacing the actual earnings on the underlying investments within the plan. So investment experience plays a huge role in driving net pension liability to go up or down. And that's why you can see, a lot of fluctuation here. 12 billion to 17 billion to 26 billion. Heck, it could go take a nosedive down next year. At the end of the day, you're wondering, okay, what does this mean for us for funding purposes? What kind of reserves do we need to have now? Because we got this big $26 million liability in our books. And as I explained last year, at the end of the day, your funding requirement is what FRS tells you to fund every month when you transmit your FRS payments to them, which is based on your number of your employees and their salary, and then the applicable contribution rate associated with those employees. So again, from a cash flow perspective, this really doesn't have any bearing on what you all do. Could this mean, higher contribution rates in the future to try to increase investment assets, decrease your net pension liability? Maybe, but we haven't seen any drastic changes historically in our FRS contribution rates.
So if I may, Mr. Chairman, so the difference between the 17 and the 26, well, $9 million difference, is that something that hit our reserves? Did that reduce our reserves?
It affects your ending net position in your, to a degree, affects your ending net position in your CAFR. So you have an increased liability. You also have changes in your deferred outflows and inflows balances that's also in your balance sheet. Right. And then that offset, whatever that difference is from one year to the next, hits an adjustment to retirement contribution expense, which is within your operating expenses.
So let me try to relate it to something that we are looking in 2021 to have a cash position challenge to buy new buses. We've said that we can get to 2021, but beyond that, it'll be a challenge. Is this going to increase that challenge? Because we're having to transfer additional funds to FRS.
Well, let's look at the situation that happened with Milliman. If Milliman got its way and said that discount rate, long-term investment rate of return really needs to be 6.53%, and the FRS went with that, that would create a much larger funding requirement, which would burden the participating entities.
We would have to send a bigger check to FRS.
You have to send a bigger check to FRS. So if you have any major actuarial assumption changes, any huge fluctuations in that long-term rate of return assumption, it is going to come down and hit on these entities that you're the ones funding this plan. Thus far things have been pretty steady. Like I said, there was a slight drop in the investment rate of return assumption, but it was slight. If there's any, significant changes, then yeah, it does impact you. And so I don't have the crystal ball. I can't predict what might happen, but things to consider. All I can tell you from historical experience that your contribution rates have not seen significant changes over the past few years. You want to move on?
Did that answer it? Because I don't want you to think we're taking $9 million out of our reserves today or even tomorrow. It just depends. This year's been a great investment year for everybody, so hopefully maybe we'll see next year an improved position. Who knows? But it's not like you're taking $9 million out of our reserves for buses.
Well, in Clearwater, Mr. Chairman, we have our own pension fund. We're not a part of FRS.
Oh, okay.
So every year, depending on what happens to our investment rate assumption versus our actual, and some years it's higher than that, and some years it's lower than that. So we go through a 5-year amortization or a smoothing process. But if there's several years that is lower, then we have to kind of make that up.
Sure.
And it actually requires assets from the city to be reallocated from the city's net general fund to our pension fund. And so I'm trying to get at this because FRS has been very successful in having a investment rate of return higher than what we've been able to get in the city. And so now if that's coming down, that's going to change our demand moving forward. I'm assuming it's going to have that go through that shock absorber process at FRS, but are we looking at having higher rates that we're going to have to pay for our FRS in the monthly assessment or the quarterly assessment going forward?
To that I can just say, these rate assumptions are meant to be long-term, right? So you're going to have rocky road in terms of actual experience all along, so let's have a long-term rate that does reflect reality, but over time. And so that's the paradigm, is what does truly reflect reality. If you have multiple years of less than stellar investment performance, maybe it is time to make a more dramatic shift in your projected return assumption. Maybe the one and it's what you're describing here is the exact same issue that the authority has with FRS. The one distinction I might say is that this is a multi-employer plan. You have a single employer plan, and so you probably have a little more insight, the city does, given that its own plan. You're not sitting in Tallahassee, studying this thing, because that's FRS, and you're basically just at the mercy of FRS telling you, here's your contribution rate and here's what it's got to be. So for single employer plans, at least you have a little more insight as to how the plan is faring along the year, and maybe you can make some better projections as to what might be coming down the road. Here it's just, this is what they tell you, and this is what you got to live by.
Okay, thank you, Mr. Chairman.
Thank you.
Okay, the last two slides on revenues, pretty much consistency in terms of federal, state, and local grants, and we've experienced that in our single audit work, that a lot of the same types of grants, similar dollars coming through from year to year. On the ad valorem tax side, we did get a bump. We're at $38 million now, basically due to increase in property values. I can say we're getting close to our 2007 level. There's in a statistical table that talks about taxes levied by the authority dating back from 2006 to 2016 for a 10-year trend. The highest was 2007, and that was $39.2 million, and you're already at $38.2 million. So you're getting close to the highest in terms of your levy back from 2007. Now, some of that had to do with the fact that your millage was lower in 7 than it is now. You've raised the millage since then. It was 0.6074 in 7. Now it's 7.7305. So that obviously is a contributing factor. But the point of the story is, you're getting your ad valorem tax revenue base up to what it was at the peak. Passenger fares is kind of where you see the biggest decline, and that's really impacted by ridership at the end of the day. So you had 14.9 million in ridership in the prior year, and now 13.3 million in the current year. So ridership down from prior year to current year, and that's reflected in your revenue here. Last slide for me is just on expenses. Again, real consistency across the board. Don't really have much to say on this. You know, you'll see operations did go down a bit. A lot of that has to do with lower fuel costs. So we had about almost a $3 million difference in fuel costs, largely due to lower fuel prices and maybe less miles traveled. But that was a big contributor to decrease in operations expense. You see a little increase in maintenance expense. A lot of that has to do with personnel costs. So those personnel, salaries, wages, benefits did go up in maintenance. But overall salaries, wages, benefits, I think was only about a $500,000 increase entity-wide. You just had bigger increase in maintenance and then smaller decreases in other departments. But that's why you see a little bit of a bump in maintenance there. Last slide.
On that,
Go ahead.
the marketing from 14 down to 7?
Green light.
Oh, okay.
Oh, and customer service also moved out of there, out of marketing into operations.
Yeah, it's not like green lights.
Yeah.
Bigger.
Employees moved to another department.
Right, so bookkeeping.
Anything else on that?
The difference between 13 and 14 with big purchase of buses? No, the next slide.
Oh, net position?
Mm-hmm.
Yeah.
Well, that's the implementation of GASB 68. So that's where
okay.
we had to start with a beginning balance, and to start with a beginning balance, that's where we took a big net position hit in that year. It's been pretty consistent from year to year. And so, yes, we did have an increase in your net pension liability, but it didn't take a huge hit on your unrestricted net position, because you also have a lot of those offsetting changes from the increase in the liability will be changes in deferred inflows and deferred outflows of resources, which doesn't drop down in net position. So while maybe you had an increase in net pension liability, you also had a big increase in deferred outflows of resources. And so if those largely offset, then it doesn't really affect your unrestricted net position as much. So we've seen pretty consistent unrestricted net position from year to year.
Any other questions?
The last slide is just our conclusion. Thanks for listening to an auditor babble for quite a long time. It's quite endurance.
Yeah, right. We appreciate it.
Yep.
Okay, anybody else have a question? No, we're set? Okay. Thank you very much.
Can't take an action item on this, I guess, until we have a quorum.
Right.
Can't do anything right now.
So maybe later in the meeting, if Mr. Eggers.
Oh, yeah.
I have
Yeah,
one,
we could
I have one comment. I mean, typically, if there's any issues that you have to flag, that's typically something that's in the management letter, and that's why the management letter is an important document, but our management letter looks great, correct?
Correct, yep. No written findings. I did have a couple verbal recommendations to management that I put in a previous slide, but yeah, no written control deficiencies or items of that nature. So it was very clean audit this year.
Good. Okay. Mr. Johnson.
Looking at the report, this is the statistical stuff. The fare box recovery rates show we're down back at the fare box recovery ratio that we were running in 2007. It had gone up to as much as almost 28%. Now we're back down to the 22%. I guess that's really not anything to do with the audit. It's just the trends over time.
Mm-hmm.
So we have, that's reflective of the decisions we made to allow more TD passes. And
Yeah. The UPass program, of course, collects revenue. That's not counted as fare box revenue.
Oh, it's not counted as fare box revenue?
No. And then the TD. We're up to about a third of all of our writers are paying only $11 a month, which was not the case in 2007.
Why wouldn't the UPass be covered as fare box revenue? It's passenger revenue.
No, it's called governmental
It's a special contract revenue.
special contract revenue. You know, St. Pete College and all the different other partners pay us a monthly amount.
So in Des Moines, where you were doing most of the UPass, your fare box
It was the
ratio
same.
was
Very,
miserable.
well, according to the auditors, it was very low. For our own internal documents, we counted it as fare box, or we showed it
Okay.
like that.
How do we do it here? When we report it to the board?
For my own personal spreadsheets, I counted it as fare box. I don't know what Debbie does.
Thank you.
I don't know what Ricky does. But if I may,
Yes,
Chairman,
please.
just a couple comments. First of all, I want to thank my staff. We were down 2 key positions during the course of this audit. My staff really came to the fore and did an excellent job. Julie Lupus, who really did all the background work, and her staff, Dana Williams, who did a great job. Nelson Dort helped put together all the statistical tables along with Michael. Putting together this whole package is quite a bit of work, and Gatsby 68 cost us about 11 pages worth on 1 footnote.
Wow.
Not easy, and we thank Clifton Larson Allen. When we went and changed audit firms, I wanted to be really challenged. And the whole point is they're an extension of PSTA to help make us better. So when we look at things, I'm grateful for them to do that. I'd rather have us come up with recommendations to do things better than having things slip through the cracks. So I appreciate everything your staff did, for yourself, Andrew, Sue, and Kim, and everybody. It's greatly appreciated, making us a better place.
Thank you. That's our goal.
Great. Thank you.
Yeah, and Mr. Chair, if I could just
Yes, absolutely.
echo that. Thank you very much to all this. A number of board members have asked me, and especially some of our newer board members have asked for a little more information about PSTA in general, and so we're planning on a relatively light April PSTA board meeting that might end at a reasonable time, and then we would have a voluntary but sort of mandatory, immediately following the board meeting, have a PSTA 101 session where we would go into a little more depth in how PSTA operates and our financial. Part of that would, not all of it, part of it would be talking about our financial position, which is very, very healthy. Thanks, of course, to outstanding financial management and reviewed by great auditors, but also that's just an historical thing. PSTA is a very healthy financial organization, maybe quite a bit healthier in the big picture than our friends over there in Tampa. And I think we'll kind of get into that in detail. It's appropriate to have this great audit because I'm told today March is not only National Procurement Month, but it's also Certified Government
Financial Manager Life.
Wow.
Certified Government Financial Manager Month.
Wow.
So, oh my gosh,
That's a mouthful, huh?
get out the party cake.
And it's Auto Appreciation Month.
Yeah.
It is?
I'm just making that up.
All right.
So, but unfortunately, we don't have a quorum for our Finance Committee.
Great.
So,
Maybe by the end of the meeting we will, and we can come back to it.
maybe. I'm trying to find out if Commissioner Eggers is able to
What
come.
can we work on here? Do we have some ideas?
Amber has a great.
We did 5A and D.
Okay. Just out of curiosity, we will have a full complement of financial committee meeting, finance committee members next month, correct? Because we're going to be voting next week on.
Yes.
Yeah.
The nominating committee met, and we have recommended, it'll be on the agenda for next week's
Next
board
week.
meeting to add Josh Schulman to the Finance Committee. to replace Mark Dighton.
Good addition.
Well, I mean, what do we have to do?
Well, I don't know,
Just hold out hope that Sugars will
why
arrive.
don't we hold off? And I had initially pushed this to the April meeting because I didn't think we would have an answer this quickly on FRS. So, we could always,
But could we still go right to the PSTA board next week to accept the report, or does the finance committee actually have to approve it?
I don't know the answer.
I don't know, let's hope for a quorum before the end of the meeting. Or we can adopt Chair Rice.
Well, if Commissioner Eggers comes up, then we validate Commissioner Scott's
And then we have a
participation.
quorum. Yeah. Well, let me confirm with our legal counsel, but I would suggest we still try to go to the PSA board. If you're able to come next week, Wednesday.
I do have a conflict, but we can
That's
figure
okay.
something out. If the meeting's at 9?
Yeah.
Well, we can put you on at a time if you need to come later or something like that, we can put you on a little later.
I mean, I'm tied up probably till about 11:30. I don't know how long.
We don't want to run that long.
I mean, if
But
it's,
didn't you tell me that if we go to April, we have to file some kind of extension?
Just for our GFOA,
I mean, I guess you can,
or we could.
I mean, I'm not dictating policy. I can just tell you what, there's divergence of practice on what local governments do in terms of acceptance by governing bodies. Some take it to an audit finance committee like this, they approve, they accept, we finalize, and then the full board presentation is more informative in nature. It's already the final issued product that we present on whatever day makes sense. Others say, management accepts, that's good enough, finalize, and then whatever goes to the committee or full board, that's informative. Others say, audit committee in draft form, they approve, then let's take it to the full board, they approve while in draft form, and then we finalize after that. So, I don't know what's
Do whatever.
written in your bylaws, or what, you know, if you need to confer with legal counsel on what the right thing to do is. Just know I don't believe there's any single right or wrong answer on how you go about finalizing the audit. I think that's more.
Are we up against a time frame for filing the reports?
March 31st for filing for the GFOA award, but we can look to get an extension on that. That's the only thing.
We have done, we've had this debate over the years, and with the former auditors as well. And I believe we have done the very first thing you said, where the finance committee actually approved or accepted the audit, and then it was the final version was at the board. And then we've also done, I think, the last thing you said, where the finance committee accepted it in draft, and then the board
Also accepted.
also accepted it in draft, and then it was presented later, like the following month. So in that case, but for the fact that you can't be there, it would be okay to do it next week, even without the finance committee.
I mean, I can have a team member there, like Sue, to give an abridged presentation or be there to address questions. If you want my formal song and dance, then I would.
If Sue can be here, that would be great, because, again, I switched the meeting dates on you and based on the FRS, so.
Right.
Okay.
We can discuss that
Okay.
internally further.
So we'll put this on the agenda for next week.
Is that all right? Do you want to?
That works for me. I'm not sure
If-
what your expectation would be at the board meeting would be.
A very abridged version.
You don't like hearing me talk?
No, I love hearing you talk.
Yeah.
That's fine.
Mr. Johnson?
Mr. Chairman, because we have a clean audit, we don't even have any recommendations. I think we could, and since we did have a quorum except one participating by phone, so this is kind of technical, I would suggest we present it at the next.
Okay.
And
With that
with
caveat,
a-
I can just make a statement of that. to
That
effect.
we heard it, although we did not technically have a
You want to check with Alan, make sure that's all right, Brad? You
Yeah.
want to-
I mean,
There's nothing in the rules.
Alan's
Yeah,
not
I
here right
don't
now.
want you to- I don't want you to,
Well, there's nothing in the rules and regulations that states the finance committee has to be the one to accept it or recommend acceptance. I mean, I know we've done it both ways.
Well, because we were short one person through the nominating process, I think we could go to the board and just
We could
say,
just put in there
say we
that it
have,
was reviewed and,
We have
yeah,
reviewed
we
and
did the
feel
full
comfortable
review, we
forwarding to
were
the-
short one person, and we'll ask for their permission to,
Yeah. And
Accept
the
it.
other thing is, I don't want to have, if you've got an award coming out, I don't want to delay things where you have to go for a special arrangement. I'd like to get it done so you can file your award.
All right, well, we'll work through it then.
Sounds good.
Okay,
Okay.
thank
All right,
you.
does everybody feel comfortable with that? Okay, well, let's do that.
Yeah, that's good with me, Joe.
Okay, good, thank you, Brian.
All right, thank you all.
Okay,
Thank you.
great job, thank you very much. Sorry to delay you so much.
No, no problem.
We just like to ask questions around here.
Appreciate the interest.
Okay, now, is there anything else that we can cover today without a quorum?
Well, I would like for Cassandra to go ahead and give her presentation on the Clearwater agreement.
Okay. Well, super.
So, we got a lot of exciting things going on in Clearwater, and we're gonna hopefully build this transit center there on Clearwater Beach.
Okay.
Thank
Super.
you,
I gotta
Commissioner
drive over
Johnson, for
Yeah.
being in a video.
I'm gonna drive over there.
Coming soon to a theater near you.
We did, you'll see on Friday, we went out to Clearwater Beach, and as you know from all the things that we've been talking about, that we are very focused on being able to get people to America's #1 beach. So we have been working diligently with the city staff to look at solutions of getting people from the mainland to the beach. And we have a series of projects that we've been working on with them. This is just one of them. So the recommendation, I guess, at the board meeting would be to agree to a partnership on this particular capital project. So as you know, we have a number of operational projects as well as capital projects coming to the beach that we've been working on. I just want to run through these quickly so that everybody is reminded that this is part of a big picture, that this particular project is not a standalone, although it has independent utility. So in October, we started the 7-day-a-week trolley service from Tarpon Springs to Clearwater. And this route had originally stopped at Island Estates. But when we start to look at all of the routes that were using the bridge and connecting downtown Clearwater with the beach, there are a lot of routes that are using the bridge but not necessarily going all the way across. And so our ultimate vision is to have a number of services go all the way across. And this is really playing out in our spring break service, where we've extended their South Beach route that used to stop at Island Estates all the way into downtown and connecting to some free parking lots, and also bringing the the coastal route all the way over to the traffic circle. And so this makes that connection. The Suncoast Beach Trolley is already doing this, and we've just extended it a little bit to circulate around downtown to get to the parking lots that the city of Clearwater has designated as free during our promotional period of mid-February to the end of April. So this has been going on for a few weeks. We have people who are parking the most popular lot is the City Hall lot, although Harborview Center is much larger. And their highest ridership day has been about 50 people. We did see a drop in some of the ridership participation last week, I think mostly due to the weather and cold temperatures don't make people want to go to the beach as much. But we are working with the city to do some other things to see how we can continue to promote this promotional time. But this really starts to get that one-seat ride for more people and connecting from downtown to the beach. As you know, our state legislative priorities also include the operations of a Clearwater Beach to TIA Express. We've been up in Tallahassee talking about this, and this is part of our overall big picture for operations. On the capital side, we've been working with the Department of Transportation and the city and looking at how we could get an exclusive busway from downtown to the beach. This is feasible from the department's perspective, and then we just need to work through it with the city. We have asked, and I believe we have sponsors in both the House and the State Senate for $1 million to continue to look at the engineering of this project. This would really help us in terms of making our operations a lot more efficient and getting through the traffic, especially at peak times. And additionally, we will be putting out an RFP for a consultant engineer to look at a new intermodal center. So we do have the funds to look at replacing the Park Street Terminal in downtown Clearwater, and this project would allow us to have something shovel-ready for when we are ready to fund the construction. And then the agreement that's in front of you today is about what we do out on the beach. So right now, we have no singular point to direct people to where all of our trolleys converge and some space for the new TIA Express. And so this would create that, a place where people would know to go or know that they have arrived at the beach via transit. We're looking at a location owned by the city of Clearwater that would accommodate 3 vehicles at any one time, and also have a pedestrian structure to a nearby parking lot. And this would allow that first mile, last mile connection for hotel shuttles, Florida free rides, could be bike share in the future. Sells my cap.
Yeah, the capital plan.
Put it in the capital plan?
Yeah.
Thank you. And then this is what it would look like, is it would be different than what we have in other places around the county. So this not be our standard shelters. What we've talked to the city staff about is having a canopy structure that would allow for shade and for rain protection, but also have a different kind of feel. Again, we're coming onto the beach. It's a different kind of location for us, and it's a much bigger space for people to wait. So our goal in doing this is having this open for spring break of next year. If we go through our regular process and this goes to the city council at the beginning of April and we get our funding agreement together, we can then put out the procurement and bring this back to you in June for approval of a contract. We would then begin the construction shortly after that. We have estimated the cost at about $500,000. City of Clearwater's commitment to us is not only financial, but it's operational. Their financial contribution, as outlined in the interlocal, would be 50% of the construction cost up to $250,000, but they've also agreed to do some extras for us. So while we will be in charge of the design and the construction and the hardscape, they would like to take the landscape, and so they will be responsible for that, both in terms of putting it out there and also maintaining it. They've also agreed to help with security through law enforcement, expedite the permitting, put out supplemental maintenance. So during high traffic times, They have additional personnel out on the beach to make sure that things are clean, the trash is picked up, and while we would be the primarily responsible for that, they would help us out and provide supplemental assistance. They would also be trained to take down the canopy in a storm event. So they already have people, again, out on the beach they have similar structures out on the beach who are trained to take those down. This is slightly larger, so they'd have additional training to help us take that down and store it.
What's the material of the canopy?
It's like a tensile fabric is the way to describe it. It's not just cloth, but it's a fabric-like.
Okay.
So like much like the Denver airport. Have you seen that? That same. Yeah. Prop canopy. Yeah.
Okay. Yeah. Okay. All right. Okay. Well, that's pretty durable, right? I mean, this is not going to have to be replaced every few years.
No, you wouldn't have a normal wear and tear, Cat 5 hurricane.
Right.
You know.
Well,
I don't know if we'd have, we do our best, right?
Right.
But we would take it down and preserve
It can
that
be
fabric.
removable during
It's
the
removable.
hurricane is
Yes.
gold.
Right. So the.
Hey, Cassandra?
Yes.
This is Brian. At what wind speed would that need to come down? I mean, it's obviously, I'm assuming just a very serious storm?
I think we would work with the manufacturer to make that determination about what level of wind speeds we'd want to take it down. I also think that we would be cautious enough to take it down whenever the city would take down their other structures.
Okay.
Good.
So
Okay,
the only change that your staff is recommending, we have been working with the city for a while on this, and while we have come to an agreement on most of the language in the interlocal, in looking at this over the last few days, we think some of the dates ought to change. So on page 2 of the interlocal, PSTA is recommending a change of those dates from May 1st and November to August 1st and December 31st. I've made contact with the City of Clearwater staff, including their legal department, and they are fine with this change.
Okay.
Page 2?
Page 2, under section 1C, where it says PSTA will endeavor to commence. Yes. So just change, we're recommending a change of those dates to August and December.
Okay, I'm sorry, go ahead.
I know you might have just covered this, but in terms of the insurance and ongoing maintenance, is that something that's split between Clearwater and PSTA, or how are we looking at?
Again, the hardscape would be owned and maintained by PSTA. So while we would have their additional assistance, we would be responsible for that.
Okay. All right, Commissioner Johnson?
Do you have a design for the parking lot that's adjacent to it, or would it still have the same striping that is there now?
It would have generally the same striping. We would take one of the parking spots for a pedestrian pathway.
I thought there was provisions made to allow for queuing of other vehicles.
Yes, we would,
Says
In
it
the-
there.
yes.
That won't necessitate restriping of the lot.
Not necessarily. No, they just have to come in and pull in. We might have to designate some spots for them to pull into. That would be about it.
So it maybe take some of the meters off,
Yes.
or the,
There are no meters at that lot. They're
That's right.
just, it's, you just have
Art
to
Mobile
designate
kind of
those.
thing, but-
Right, right. It's a ticket vending machine.
we may have to reserve
Right.
several spots for pickup.
Yeah.
Wait.
Is there staffing there?
No.
No.
No staffing?
You don't need to do that particular part of the project until you have the Beach Express. Because the trolley service itself can get people to where they want to go. But if people are coming from the airport and you want them to connect to their hotel shuttle, that's when you want them to be able to come into the parking lot. And so we've talked to the city about if you had a hotel shuttle come into that parking lot, how would that work, and then how would they circulate back around? But for people who are coming in to the beach on the trolley or going off the beach, you know, that you wouldn't necessarily have to designate more than one spot just for the pedestrian connection.
I have a question, actually, for Commissioner Johnson. What do you think will be the impact for the city? Will this be a dramatic improvement in terms of moving people around and so on?
Well, the big challenge is because the buses at high peak time get stuck in the same traffic.
Right.
You're not going to move a lot of people out of their cars into public transit. Once the exclusive lane occurs, then we would have that option at that peak period of time.
Okay.
We have a 700 car parking structure on the beach that opened, and I was out there yesterday, and you know, it's only to level 2, level 3 full at midday, so you need to get people used to using that will help. What this does is it provides the linkage for the pedestrians, really. And because we get more pedestrians out here, one bus ride from Tarpon Springs.
Okay. All right. So,
I would normally ask for an approval to recommend this to the board, but since we are
we like it, but we
limited.
can't
Exactly.
do it right now. Yeah, go ahead, I'm sorry.
Cassandra, what's the timeline on when the bus lane over the bridge would be ready?
Well, I think we would, if we got the money to do the design work, that would probably take maybe another 18 months. And then if we could get it into the MPO's plan, it could be done after that. I mean, that's up to the department, really. The biggest part of this is creating the lane out of the raised median through the Department of Transportation. So I would defer to them. I can make a phone call and see what they think the best scenario. I mean, it would take a few years for us to get a lane on the bridge. We are looking at some other short-term options, but without an agreement from the city.
So it's in the center of the bridge?
It would be in the center of the bridge, in the raised median, yes.
That's going to be one lane only though, right? So we have to make sure that we've got a timing issue with regard to which way buses will be running.
We think we could get 2 lanes.
Can you? Okay. All right.
That would be great.
I'm trying to see how many feet of walking to get to the water from this spot, but I can't do that.
It took Aaron and I yesterday about 5 minutes to get from that parking lot to the middle of Pier 60.
Yeah, I mean,
And also, I couldn't quite tell in all the details,
Yeah.
but would there be a covered area where people could stow luggage while they're waiting for their connection to the hotels?
Well, there's the cover, this area along the roadway would be for the vehicles, so these are 2 vehicles. This area would be covered. This is one option for us to have covered area. This would be another option, so they would be able to wait with their luggage.
Okay.
There's no lockers or anything. There's.
No, I didn't mean locker. I just mean like a place where people can still have plenty of room to walk, where the beachgoers to get to their destination, but then the people with lots of luggage there'd be a room for.
Yes,
where they
there's
stand
lots
aside.
of, there's lots of space there.
Okay.
That could be solved by somebody calling while they're on the bus, calling the hotel and going to the 10 minutes or something like that.
Well, that would be the idea with the Beach Express, is that if people are headed to the beach, they've got on at the airport, and that the operator could call ahead
Okay.
to a dispatch center and say how many people they've got for each hotel, so the hotel shuttle could meet them there.
Yeah. Okay, great. Very exciting.
It is,
It's
you know,
very
I failed to mention one thing, which is probably one of the most exciting things as part of this project is that the city has a meter there, a light meter. So if the traffic gets backed up on the beach, they stop the traffic right at this location at East Shore. And they would make it so that we could use this as a bus queue jump. This would be the first one in Pinellas County. And what it would allow us to do would be to pull out of the bus bay and get in front of the traffic as it's metered out.
Go ahead, Norma.
Yeah, I can't help but think, this is just great work to you and your whole team, Cassandra, and everyone at Clearwater who's making this project possible. I can't help but think that, I wish we could see this level of cooperation with St. Pete Beach on our BRT project. And it would seem to me, if I saw the great progress of what was happening here, it would make me more anxious to make sure that the BRT project comes to, if I was a St. Pete Beach person, I would make sure that we were keeping up, because the development of this type of mass transit to Clearwater, we never want to think about Clearwater competing with St. Pete Beach, but it clearly puts St. Pete Beach at such a continued disadvantage to not have easy transit to their beautiful beaches as well. So, sorry, that was an editorial comment.
We concur.
Yeah, yeah.
Okay.
Thank you.
All right. Thank you, Cassandra. And good work with all your team. That's great. Okay, at this point, we're kind of 5 minutes over our normal time anyway. I want to hold up the planning committee. Do they have the older people here? Do you have anything?
We do not. We don't have a quorum for the planning committee either, so, but we've got some exciting things on the planning committee.
Can we take a 3-minute break here?
Sure.
Okay. I'll be right with that.
So, Mr. Finance Committee Chair, do you want to?
Well, we'll terminate this meeting at this point, and we'll move forward to present next week to the board. If you can, work with me, we'll make a statement on the fact that we did not have a quorum, but we do the audit and just satisfaction audit, and we'll move forward.
And this Water Beach agreement?
Absolutely, this goes forward.
Okay.
Yeah.
Well, it would be forwarded without official recommendation.
Yeah.
Right,
Mhm.
right. Okay.
Brian,
Thank you,
very
Brian.
much for dialing in.
All right, well, it was good to watch everybody on TV this morning, so thanks for allowing me to participate via phone, and I'll look forward to seeing you all next week.
We spent
Okay.
a lot of time putting on makeup in the green room, so it worked out great.
All right, take care, everyone.
All right, thanks.
Bye.
Great job, Judy. Thanks.
That's how, so.